everybody to today's webinar about the new lease standard. As Nancy mentioned, I've been with Saltmarsh about 13 years, and I work primarily with manufacturers, nonprofits, and some service industry entities. And I think I can say that this standard is probably going to have a more serious and significant impact on those entities than the revenue recognition standard from a few years ago. So definitely a very hot topic right now, and it is right around the corner. So we literally have 3 months left until this standard becomes effective. But obviously, it wouldn't be 2021 with a few last-minute snafus, a little bit of excitement coming from the FASB. Just 2 days ago, they had their Public Company Council, the PCC. They met, and there was some discussion, especially from practitioners as well as industry representatives, that are actually suggesting delaying this standard for another year. It's not quite sure yet what the FASB's take is on that, but the argument that those individuals were bringing forward is that practitioners, CPAs, typically help industry companies with their implementation of new standards, and the resources available right now to CPA firms as well as those in industry are very limited, and there is a chance that they might not be able to provide those services to entities in industry. So that's their argument to potentially delaying this one for another year. So definitely stay tuned over the next 3 months to see if there's going to be anything that the FASB decides on that. On the other hand, there were investors and especially bankers that are saying, now is the time, let's go ahead and do it. They really wanted this one implemented a few years ago. So again, we'll see what's going to happen with this one. But it's another one of those things in 2021 that you just never know what happens. But let's go and get started. So on the agenda today is just to start out with just a little bit of refresher of how we're currently accounting for leases. Just to really work out the differences between the current and the soon-to-be current accounting. I'll talk a little bit about the background of the ASU 2016-02. How was it developed? Who was involved in it? Why was it developed? Talk a little bit about the scope and some of the terms that are included in the new standard, defining those to make sure that you have a clear picture of what you need to be looking out for once it comes to implementation. I'll go through the actual debits and credits, some of the journal entries, using some examples to show you what that would look like come January 1. I'll also talk about some of the presentation and disclosure requirements that are included in the new standard. Talk about the transition accounting, what you need to do once you implement it, how are you going to get all those leases on your books. And then finally, talk a little bit about some other implications that this new standard has. So let's go ahead and start off with our current lease accounting. I'm sure everybody, I'm not saying anything new here, but I'm sure everybody does realize that currently from a lessee perspective, there are two different types of leases. The first one is the operating lease, and that obviously is a very simple, straightforward recognition. The expense is recognized on a straight line basis in the income statement, and the notes will include certain disclosures about future payments that you have already committed to under those lease agreements. There might also be some maturity date expirations in that note disclosure as well. The other form of leases is the capital lease, and I'm sure everybody can think back to whenever they were in school learning those 4 different criteria for the capital lease. So if the lease meets one of those 4 criteria, it does qualify as a capital lease. And those criteria, the first one is a transfer of ownership at the end of the lease. The second criteria is that bargain purchase option, which often in a lease agreement you might see a $1 purchase option at the end of the lease, so that would be that bargain purchase option. The next criteria is that the term of the lease is greater than or equal to 75% of the useful life of the asset. And the fourth criteria is that the present value of the lease payment is greater than or equal to 90% of the asset's market value. So again, if your lease meets one of those 4 criteria, you would have had to account for it as a capital lease. And if you have a capital lease, you would have recognized an asset and a liability on the balance sheet. You would have recorded an interest expense as you make the payments and reduced the liability accordingly. You would have depreciated the asset, recorded depreciation expense on the income statement, and in the notes, you would have disclosed the future payments and interest payments that you would have to make under those lease agreements. So again, just a quick overview of what lease accounting looks like right now. So let's jump right into the new standard, ASU 2016-02, the codification. You'll actually find that in topic 842. So this standard was actually issued by the FASB back in February of 2016, so almost 5.5 years ago by now. The whole process did obviously start several years prior to that, so you can see it really has been a long time coming. The implementation date was delayed last year by ASU 2020-05. So during the pandemic, the FASB decided that requiring non-public entities to implement the standard effective 1/1 of 2021 would be an undue burden. So they decided to delay that implementation for an additional year. So the way it reads now is that the effective date is for periods ending after December 15th, 2021. So effectively, that's an effective date for calendar years of 2022. This standard did take effect for public companies back in 2019. So with that, you obviously have a good resource once it becomes time for you to start preparing your financial statements, to just pull up the financial statements of a public company, just take a look at how are they treating leases, what are the disclosures that they're adding. So that's obviously always a good resource. This new standard on leases was actually part of that whole convergence effort that was done between the FASB and the IASB. And I'm sure that you recall that the revenue recognition standard, ASC 606, was part of that project as well. So there are actually some similarities in terms of definitions and items in both of those standards. And I'll point out a couple of those later on. But again, so this standard was part of that convergence effort. And the FASB and the IASB, they actually did reach different conclusions, which I'm sure doesn't come to as a huge surprise to most people, as it relates to how leases should be treated. And as a result, they did issue separate guidance. So the FASB guidance does not look like the IASB guidance. There are some differences, but I'm not going to talk about those today. The purpose of the new standard is really to increase the transparency and comparability amongst organizations. And if you've seen webinars before about the new lease standards or read about it, I think there's always this one example that's being used of a FASB official that was looking at a set of financial statements for an airline and was surprised to see that the airline did not have any airplanes in their assets section on the balance sheet. And obviously that was because all those airlines are leasing their airplanes, and it's an off-balance sheet transaction. They only recognize the expense on the income statement, they add some disclosures, and they're done. So that increase in transparency and comparability was one of the main reasons for this new standard. And the core principle is to recognize a right of use asset and the related liability on the balance sheet. So in summary, you could say that all your leases, with certain exceptions that I'll talk about, they will show up on your balance sheet. The income statement recognition will depend on what type of lease you actually have. And I'll show you some examples here in a little while. So the new standard, ASU 2016-02, actually continues a lot of the different classification from our legacy GAAP, which you can find in ASC 840. So from a lessee's perspective, you have two types of leases. You have an operating lease and a finance lease. And the finance lease is really the equivalent of what we now know as a capital lease. On the lessor side, you have sales type leases, direct financing leases, and operating leases. The one difference or the one update on this new standard is that leverage leases are no longer included in the standard. And actually the entire accounting from a lessor perspective has not changed much at all under the new standard. And because of that, I'm really just going to focus on the lessee side of the new standard and not spend any time on the lessor accounting. So let's start talking about the scope and the definition of certain terms that are included in the new standard. So the scope of the standard is that it applies to property, plant, and equipment, but not to intangible assets, inventory, or assets under construction. And that actually is consistent with our legacy gap, so there's no change there. But it's just important to know that if you're trying to evaluate a contract as it relates to an intangible asset, for example, you would not account for that contract under ASC 842, under the new lease standard. The standard defines a lease as a contract or part of a contract that conveys the right to control the use of an identified property, plant, or equipment, which is an identified asset, for a period of time in exchange for consideration. So the first thing I want to point out here is that you can already see it starts out with that a lease is a contract or part of a contract. So you have to be careful that when you evaluate the various contracts that you have, that you don't just look for the ones that actually say lease in the header. There could be instances where certain service contracts might have an embedded lease in them, and you would have to identify those and account for those under the new standard. And for a contract to be included, to be a lease or to have a lease included in it, there must be, again, an identified asset, and I'll talk about what that exactly means here in a second. And the contract must also grant the customer the right to obtain substantially all of the economic benefits from the asset, and this is what they refer to as the economic criteria. And it also has to give the lessee the right to direct the use of the identified asset through the lease period. And this is what they refer to as the power criteria. And I will go into a little more detail here on the next couple of slides to kind of explain to you what that means and what the impact of that would be. So let's first talk about what an identified asset is. The contract must explicitly or implicitly specify the asset. And obviously the easiest way to do that is if you, for example, lease office space. It clearly identifies the address that the office is at. It might include the suite number, but that is a very simple, easy way for identifying the assets. There could be instances where that is not explicitly stated, but implied in the lease. So you certainly have to look for that. And an asset, so here are a couple of nuances in the new standard that you do have to consider. Because an asset is not considered to be specified if the lessor has a right to substitute this specific asset by other assets. What's important to note here, though, is that the substitution right has to be what they call substantive for a lease not to include an identified asset. And under the new standard, a substitution right is actually considered substantive if the lessor has the practical ability to substitute alternative assets throughout the period and also would benefit economically from the substitution. So you have to meet both of those criteria for it to be a substantive substitution right, which in turn would result in the lease not having an identified asset, and therefore it would not be accounted for under ASC 842. So again, the right to control use is made out of two criteria: the economic criteria, which means that the lessee has the right to obtain substantially all the economic benefit, and that really is derived from just simply using, holding, or subleasing that asset. So pretty simple concept. The power criteria means that the lessee has the right to direct the use of the asset, and that really means that the lessee can direct how and what purpose he or she is using that asset for. Sometimes you might find certain limiting terms in a lease agreement. For example, it might specify a maximum amount of usage for that specific asset. Or it would require that a customer follows industry standards for operating procedures, or requires notification of changes in how or where the asset is being used. However, those terms would not prevent or would not mean that the lessee does not have a right to use the asset. So that would not get that contract outside of the scope of ASC 842. So let's look at a quick example to kind of show you what those terms mean and how that actually plays out with a contract. So let's assume that a customer enters into a contract with the manufacturer for the use of a copy machine for 3 years. So a very typical arrangement that you might have. Under the contract, the copier is explicitly specified by serial number, but the manufacturer has the right to replace the copy at any time during the agreement. While the contract specifies the location of the copier, the customer has the right to move the copier to any of its facilities upon 3-day written notice. So this contract here does contain a lease. There is an identified asset. We have a copier machine with an identified serial number, and the customer has the right to control the use of the asset. He can use it however he or she sees fit. He can move it around between facilities with only a 3-day notice. So we have a lease in this case. The question now becomes is, does the lessor have a substantive substitution right that would negate this lease or would not require this lease to be accounted for under 842? So in this case, the supplier, the lessor, would actually have to incur additional costs if he were to replace that specific copier. It would be costs to bring a new copier into the office, remove the old one, the transportation back and forth. So in this case, although there is a substitution right, this is not considered to be a substantive substitution right. And as a result, this does qualify as a lease under ASC 842. I'm sure everybody has heard of this practical expedient that's included in the standard. And I know that a lot of people have probably thought to themselves, well, if I can just structure every lease to where it is a short-term lease, then I won't have to worry about this. But it's actually not that easy. So what this standard does is it includes a practical expedient for leases with terms of 12 months or less, and leases that do not include a purchase option that is reasonably certain to be exercised. So just a couple of things to point out here. First of all, a short-term lease of 12 months or less is still within the scope of the new standard. It's not outside of the scope. However, there is a practical expedient included in the standard that would allow you to account for those leases under basically a straight line expense, straight to the income statement approach, and not having to record a right of use asset and a liability. And the FASB actually notes that entities may adopt a reasonable capitalization threshold below which the lease assets and lease liabilities are not recognized, consistent with other applications of accounting policies, such as capitalization of property, plant, and equipment. So I know that and we've actually received a couple of questions prior to the webinar, questions about materiality and whether or not you can use that methodology of not recording leases under the new standard. And although materiality is more of an auditing term than an accounting GAAP term, I would certainly suggest that you get with your auditor to discuss that and see if that maybe is an option if you only have 1 or 2 small little leases. But it also looks like the FASB has recognized this potential for not recording certain leases under the new standard. But again, they're looking for a reasonable capitalization threshold. So if you were to say, for example, you're going to use a $50,000 threshold for leased assets and liabilities, but only a $2,000 for cash acquired, assets, I'm not so sure that that would mean the reasonableness test in this case. So again, if you have questions about materiality and whether or not the standard applies and you should be using it for your leases, certainly get with your auditor on that. So let's look at a quick little example here as it relates to short-term leases. Let's assume that the builder is engaged to construct a 60-story building and leases a crane from supplier company for 6 months during the time that the frame of the building will be erected. The lease agreement specifies a crane to be used, and although it does not allow the crane to be relocated without the supplier company's approval, it otherwise allows the builder to direct the use of the crane. The lease does not include any renewal options, although in practice the builder could release the crane at then current market rates at the end of the lease term. So this agreement would also include a lease. We have an identified asset and the lessee has the right to use the asset. So those are your first two steps. However, we do have that practical expedient for short-term leases, and that is actually applicable here. So you can use, or you could use that practical expedient and not account, not using ASC 842 to account for this lease, and you would just expense the lease payments on a straight line basis and take it straight to the income statement. So the next item and definition that is being used in the standard is the unit of account, and this really covers whether or not you have to break out certain items if there are multiple items included in one document, or if you have multiple contracts, agreements, if they need to be combined into one. And the standard actually says that if the lease includes multiple assets, you do have to separate those and probably assign some kind of a proportional value to each one of those items that are included there. If you have contracts that were negotiated as a package, or where the consideration for one contract depends on the price or the performance of the other contract, you would have to combine those into one contract and treat it as one right of use asset and one lease contract. The new standard also talks about lease components and non-lease components, and probably the most common example of that is CAM fees for office building leases or property taxes, or maybe there's some cleaning services that are also included in that lease agreement. And the separation, or the requirement to separate those two items, is actually not new. So that requirement is also included in our current GAAP, but it has some more significance under this new standard. And you will see here in a second that if you were to combine those non-lease and lease components, that will increase the value of the right of use asset and the lease liability. So you do want to be careful about this. There is a practical expedient included in the standard where you could elect to just not separate those non-lease components. But again, you want to make sure that you really go through all the consequences and see what it looks like, including it or not including it, because again, the right of use asset, the value of that and the value of the liability is going to be higher if you do include those non-lease components. And the election of this practical expedient would be made on an asset class basis and not on a lease by lease basis. So let's go ahead and look at the classification of the leases. As I mentioned at the beginning, from a lessee perspective, there are two different types of leases: an operating lease and a finance lease, or what we refer to as a capital lease under our legacy GAAP. The standard includes actually 5 different criteria that you have to evaluate to determine whether a lease is a finance lease or an operating lease. And you'll see here in a second that there really hasn't been much change. The first criteria talks about the transfer of ownership of the underlying assets at the end of the lease, so very similar to the first criteria that we're all used to. The second criteria talks about granting the lessee an option to purchase the underlying asset that the lease is reasonably certain to exercise. This is the equivalent or of our bargain purchase option. The next two criteria, the verbiage has changed a little bit. The third criteria talks about the lease term being for the major part of the remaining economic life of the underlying asset. So you can see here that the FASB has removed that really bright line, that 75%, and replaced it with a word major. And the fourth criteria talks about the present value of the sum of the lease payments and any residual value guarantee by the lessee that is not already reflected in the lease payments, equaling or exceeding substantially all of the fair value. Again, FASB is removing the bright lines here, the 90% mark with the term substantially all. And obviously this leaves the user and the company up to defining what those terms major and substantially all is. And interestingly enough, the FASB has actually helped with that a little bit, and they're saying that a reasonable approach in this would be to use 75% instead of the term major and 90% instead of the term substantially all. So you can see the first four criteria in the new standard are really not different to the ones that we're already used to for the capital leases. The new standard did add a fifth criteria though, and that fifth criteria has to do with the underlying asset being of such specialized nature that it is expected to have no alternative use for the lessor at the end of the lease. So if you have a really, really specialized item that you're leasing and you ask the lessor to manufacture for you, that would create a finance lease in this case. If your lease is not meeting any of those criteria, you have an operating lease. Let's look at a couple of other terms. The term lease term is important to make sure that you get that right, because it impacts how you're calculating your right of use and lease liability amount. So the standard is defining the lease term as all non-cancelable periods that are included in the lease, plus any period covered by an option to extend if it is reasonably certain that the lease will be extended. So they're using a term reasonably certain here, and FASB has been interpreting it and comparing it to the term reasonably assured, which is used in ASC 840. And this is really a high threshold that has to be met for something to be reasonably certain. The term lease payments in the new standard includes any fixed payments that are included in the lease, any variable payments that are based on an index or rate, the purchase price option if it's reasonably certain that it will be exercised, any penalty payments if reflected in the lease, any amounts that are probable of being owed under a residual value guarantee, and it will be reduced by any lease incentives paid or payable by the lessor to the lessee. So in determining the amount of your lease payments and whether or not it's reasonably certain that an option will be exercised, a company really needs to consider a lot of different factors that come into play here, including the terms of the lease or the conditions, the significant leasehold improvements, if you as the lessee have made those to the leased property, what the expected economic value is of those leasehold improvements at the end of the lease, whether or not you have costs that would relate to exiting the lease or negotiating a new lease, relocation costs, and so on and so on. So there are various different factors that come into play in determining whether or not it is reasonably certain that you will exercise any extensions. So let's take a quick look at an example here. Let's assume that the retailer uses a building from owner. The lease includes an initial term of 15 years plus 5 years optional five-year optional renewal terms. Prior to opening the store to the public, the retailer must complete the construction of significant leasehold improvements in order to align the building with retailer's brand image. The leasehold improvements are expected to cost $500,000. The building is expected to have a remaining economic life of 30 years at lease inception. However, the retailer concludes that the leasehold improvements have an economic life of only 20 years, as it's the retailer's experience that after 20 years, the building will require a major remodel in order to refresh the brand and remain competitive in the market. So without going through the different steps of determining whether or not we have a lease, I think it's pretty obvious that there is a lease. Now you have to determine what is the term of the lease. Is it reasonable that the retailer will exercise one or two or maybe all of the extension, the option to renew the lease? And because of the substantial investment that the retailer made at the beginning of $500,000 and an expected useful life of 20 years, after the initial 15-year term, the value, the carrying value of the leasehold improvement will still be $125,000. So there is a reasonable assumption that the retailer would use one of the 5-year renewal options for this lease, just due to the fact of that significant investment that was made up front. Here's another example that relates to determining what the lease payment amounts are. Let's assume that Susie Stitch and Sew enters into a 5-year lease agreement with a mall operator that includes 3 5-year renewal options. The rent payments are $5,000 per month, plus 1% of sales during the initial term, with base rents increasing by 10% in each renewal period. There are no non-lease components. Susie incurs cost of $100,000 when installing the leasehold improvements. The leasehold improvements have a useful life of 8 years. The lease requires Susie to remove the leasehold improvements at the end of the lease term. Because the leasehold improvements have a useful life that is longer than the initial lease term, Susie is reasonably certain to exercise the first renewal option. So we know we have a lease, we've determined the lease term. Now let's look at the lease payments. We have a fixed payment amount of $5,000 per month in the first term and a variable amount of 1% of sales. However, because that variable amount is not based on an index or a rate, this would actually not be considered part of the lease payments. So you would only look at the fixed amount of $5,000 per month, and then with the extension, it would be $5,500 per month. So the initial term is $6,000 per year, $60,000 per year. In the extension, you would have $66,000 per year for a total of lease payments of $630,000 in this instance. The last item that I want to talk about, and the last definition that's really important to understand, is that of initial direct cost. This item is probably the second most significant impact on lease accounting, besides the fact that we are now moving all the leases to the balance sheet. The initial direct costs are added to the value of the right of use asset, and they represent any incremental cost that would not have been incurred if the lease had not been executed. So the items that we typically think about are legal expenses, for example, tax advice, consulting services that you incur, or any commission that you might pay, any payments that are made to an existing tenant to incentivize that tenant to terminate its lease. And those last two, the commission and the payments, those would still be considered under the new standard initial direct costs. However, the big change comes in with as it relates to initial direct costs that were incurred before the lease was actually obtained. So before it was signed or before it becomes effective. Those costs are no longer considered initial direct costs and would, as a result, be expensed rather than added to the right of use asset. So as you can see, the definition of initial direct costs in the new standard is substantially narrower than the definition in the existing leasing guidance. So this will, again, have a very significant impact, as many companies that have active leasing programs, they're probably capitalizing a lot of those external legal and consulting fees right now. and under the new standards, they will no longer be able to do that. So again, this is going to have a pretty significant impact going forward. All right, now that we've talked about the various different terms that are being used in the new standard and kind of gotten a good understanding of what that means and what all plays into that, let's look at how we're actually accounting for leases under the new standard. So the initial measurement is that we're recognizing a right-of-use asset and a lease liability. The lease liability is calculated as the present value of lease payments not yet paid, discounted at a rate for the lease. So this is very similar, obviously, to the current way of calculating the lease liability for capital leases. The interest rate that should be, the discount rate that should be used to calculate the present value should be the rate that is implicit in the lease. And I know that a lot of different lease agreements typically do not include the discount rate. I'm just thinking about office space leases. You typically would not find the implicit rate in those agreements. One of the agreements that you might find those are vehicle leases. Those agreements are typically pretty detailed, and you can see what the interest rate is that is being used to calculate the monthly payments. But typically you would not find that, and it usually is not that easy to obtain either. So in that case, if you can't find the implicit rate, the lessee should use its incremental borrowing rate. And the incremental borrowing rate is the rate which the lessee would pay to borrow funds under a collateralized loan for similar payments across a similar term compared to the lease. So that would be your incremental borrowing rate. The standard does include, and that was actually one of the last revisions or additions to the standard, that there's now a practical expedient to using a risk-free rate instead of your incremental borrowing rate. So this sounds pretty good. Practical expedient sounds like it's going to make it a little easier, and it does make it a little easier. However, you really do have to be careful with this one, because I'll show you here in a second what the impact of that could be. And finally, the value of the right-of-use asset equals the amount of the lease liability plus any lease payments made at or before the commencement date of the lease, plus any initial direct costs, less any lease incentives that the lessee receives from the lessor. So that covers the initial measurement of the right-of-use asset and the lease liability. And the initial measurement is actually the same for operating leases as well as financing leases. So let's go ahead and take a look at what the subsequent measurement, the subsequent recognition looks like. And that one is actually different between finance leases and operating leases. For finance leases, the right-of-use asset will be amortized over the term of the lease on a straight line basis. So very similar to your typical depreciation expense of capitalized assets. The lease liability will be measured each period at the present value of the remaining lease payments, and you recognize the interest on the lease liability using the discount rate in the income statement, and the lease liability will be reduced for the principal payment. The easiest way here obviously would be to create an amortization schedule for that lease to determine what those amounts are on an annual or monthly basis, depending on how you want to record that. For an operating lease, the subsequent entries and measurement looks a little different in that you're actually recognizing a single lease cost that is calculated on a straight line basis. So you would sum up the lease payments and would divide those by the number of years in the lease term, and that would be your annual lease cost that you would recognize on the income statement. The lease liability would be measured similarly to the way it's done under a financing lease. So again, you would expense the interest and reduce the liability by the principal portion. One other important aspect here is that the right-of-use asset does have to be tested for impairment. It is a financial asset, and because of that falls under that requirement. And I will show you here in a second why that is significant. So let's look at a quick little example. Let's assume that a lessee leases a piece of equipment under a 10-year lease. The lease payments are $50,000 per year, and payments are due at the beginning of the year. The lessee pays a commission of $15,000 to its broker upon executing the lease. The lessee is unable to determine the rate implicit in the lease, but its incremental borrowing rate is 5.87%. The lessee expects to benefit from the use of the equipment evenly throughout the lease term. So we have a lease here. We know what our lease payments are. It's a total of $500,000, which $50,000 is going to be paid on commencement date. $450,000 will be paid later on. We have direct initial costs of $15,000, and we have an incremental borrowing rate of 5.87%. So once you calculate the present value of the lease liability, you would use the $450,000 that are being still to be paid at 5.87%. That gets you a present value of $342,017. So that would be your lease liability, the amount of your lease liability. Now, so I mentioned earlier that there is a significant impact of potentially using the risk-free rate. Let's just assume that we don't want to use the incremental borrowing rate, and we want to instead use the interest-free rate, the risk-free rate. If we were to use the 10-year treasury note, which right now hovers somewhere around 1.5%, and we would use that percent to calculate the lease liability over 9 years, that difference would be $76,000. So your lease liability would be $76,000 higher using the risk-free rate compared to your incremental borrowing rate. And the spread between those two, let's just assume your incremental borrowing rate is somewhere around 5% right now. The spread between that and the 1.5 risk-free rate is pretty significant. So the longer the lease term is and the larger the lease payments are, that difference is going to be pretty significant. So if you want to use that practical expedient, you really have to calculate and make sure that you are considering all the different consequences that come with that. Okay, so now that we have identified and calculated our lease liability, this is the journal entry that we would make for either the finance lease or the operating lease. Again, that initial journal entry is going to look the same. We've got the right of use asset at $407,017, a lease liability of $342,017, cash of $50,000 as a credit going out for the first year lease payment, and $15,000 in initial direct costs. So that is the journal entry to put the lease on the books. Again, it doesn't matter here if it's an operating lease or a finance lease. So let's look at what the journal entries look like, assuming this lease is a financing lease at the end of the first year when that second payment is being made. If you were to create a amortization schedule for this lease, you would get those amounts of interest expense and lease liability straight from that amortization expense. You're paying $50,000, and $20,076 would be applied to interest expense, and $29,924 would be applied to the lease liability. Then you would also record the amortization expense of the right of use asset, which in this case would just simply be the value of the right of use asset divided by 10 years, which gets you to $40,702. So let's look at what that would look like if the lease was an operating lease. Again, under the operating lease, you would record a lease cost on a straight line basis. In this case, the straight line basis, the amount that it would be based on would be the $500,000 of total lease payments plus the $15,000 in initial direct costs divided by the term of the lease, which would get you to $51,500. The reduction of the lease liability would be the same amount as it was under the financing lease. We have a credit to cash of $50,000, and then the credit to the right of use asset, that is almost a plug. I mean, there's really no other way to calculate it other than basically seeing what's left, what's the credit that I need to make this journal entry balance in the most simplistic form, really. So with this being said, let's look at what actually the financial statement impact is of that second payment. So under the financing lease, our right of use asset would be amortized down to $366,315. Under the operating lease, after that first year, that right of use asset would still have a value of $375,593. So almost $9,000 more. The lease liability, that amount would be the same because, again, you're reducing that amount by the same amount, no matter if it's a financing lease or an operating lease. And the income statement impact, you can see, is less for an operating lease than for the financing lease. Obviously, this trend is going to change over time as you go further into the lease term. The income statement impact is going to stay the same for the operating lease, but it will be less for the financing lease. So let's start talking a little bit about the presentation and disclosure requirements under the new standard. The new standard requires you to show the right of use asset and lease liabilities resulting from operating and finance leases separately. So you cannot have them presented in one line item on the balance sheet and then not break them out further in the notes. You can show them on one line item. However, there needs to be additional detail then in the notes where you're breaking out the right of use asset values and lease liability assets values for operating leases as well as financing leases. So that has to be broken out either on the face of the statement or in the notes. Also, if you are showing a classified balance sheet, you have to break out the current portion of the lease liability. That has to be separated out. Interest and amortization expense has to be presented in the same manner as any other interest or amortization expense on the income statement. The lease expense for operating leases should be classified within continuing operations. On the cash flow statement, the financing lease payments, they will be split between the financing section and the operating section. For operating leases, all those payments will be recorded in the operating activity section of the cash flow statement. Additionally, you have to disclose financing lease costs. You have to segregate the interest and the lease liability payments and the amortization amount of the right of use asset. You have to show separately the operating lease costs, the variable lease costs, and you have to separately identify for financing and operating leases the cash paid and segregate it between operating and financing activities on the cash flow statement. You have to show the supplemental non-cash activity from putting the right of use asset and the lease liability on the books. You have to show the weighted average remaining lease term and the weighted average discount rate. So you can see there's a lot more disclosure requirements under the new standard compared to the old standard. And you also have to disclose the fact that you as the lessee have elected certain practical expedients that relate to the short-term leases, as well as separating the lease and non-lease components. So that has to be disclosed as well. So let's quickly talk about the transition. How are you going to put all this activity on your books come January 1 of 2022? Initially, when the standard was issued, there was only one way for you to do it, and that was the modified retrospective approach, which means that you would have to apply the new standard as of the earliest comparative period presented. So if you have comparative statements, both of those years would have to be shown using the new standard and accounting for those leases under that new standard. ASU 2018-11 added a different approach, the effective date approach. And so under this approach, you would actually only apply the new standard as of the effective date, January 1, 22, where the comparative periods are still going to be presented under current US GAAP. So you would have to include the current disclosure requirements for leases, and then also include, so that would be for the prior year, and then for the current year, you would have to show the disclosure requirements under the new standard. So that could potentially get a little convoluted. Certainly get with your auditor on how you want to handle that. The adjustment will be through retained earnings, through your equity, as an adjustment to beginning balance. So that's how you will get those leases on the books. There are a couple of other practical expedients that are included in the transition guidance. One of them is that you as the lessee will not have to reassess whether any expired or existing contracts are or contain a lease. So if you've already made the determination whether or not something contains a lease, you don't have to revisit that. You don't have to go back and reevaluate those contracts again. You're just going to go forward with the evaluation that you've made at that time. There is also no need to reassess the lease classification for any expired or existing leases. So if you have identified and classified a lease as an operating lease, that lease will be continued to be treated as an operating lease. If you've identified it as a capital lease, that lease will continue to be treated as a finance lease in this case. And lastly, there's also no need to reassess any initial direct costs for any leases. So if you capitalized any legal or other consulting fees that were incurred before the lease was obtained, and you added those to the leased asset, you do not have to adjust that. You can go forward with that treatment and don't have to make any adjustments for that. One thing to note here is that all those practical expedients have to be elected as a package, and they must be applied by an entity to all of its leases. So you can't just pick and choose. So this is one election, and it's going to apply to every single lease that you have. Lastly, I just wanted to cover a couple of things, some other implications that the new standard has. And those really are two different areas where those implications come up. One are debt covenants, and the other one is income taxes. If you think about how the lease is being recorded on the books with everything moving to the balance sheet now, is you will have a current portion for your lease liabilities. However, the right of use asset is a non-current asset, so there's no offset on the asset side. So if you have debt covenants that include ratios, covenants that are calculating ratios that include current liabilities, you certainly want to get with your banker to make sure that both parties are understanding what the impacts are, or maybe there's a change, an amendment that you need to make to those covenants to make sure that you're not going to fail those covenants. On the income tax side, there's also going to be a recognition of new deferred tax asset and liabilities for the previously unrecorded lease-related assets and liabilities. They're going to be new or revised book to tax differences that are included in the provision for income taxes. And this specifically stems from the different treatment of initial direct costs being expensed under GAAP, but potentially being capitalized for tax purposes. So those are some of the more significant implications that the new standard has outside of the obvious one with having to put everything on the balance sheet now. So that is really everything I wanted to cover today. As you can see, this was a high-level overview. If you look at the actual standard, there are so many little nuances in there, and you can definitely get lost in the details in there. Again, I think the items that I covered are the ones that are most applicable to everybody. Certainly from our experience with dealing with various different clients, those are the concerns that they have. It comes down to identifying whether or not you have a lease. Make sure you look at all the different contracts that you have and evaluate those. Identify the lease term, the lease payments, decide which interest rate you're going to use. Are you going to use the interest-free rate? Make sure that in that case you will have to apply that to every lease that you have, current and future. So if you're thinking about expanding your operations, potential future leasing arrangements that you might have, think about what impact that might have if you were to use the risk-free interest rate rather than your incremental borrowing rate. And then obviously deciding what type of lease you're dealing with. Do you have an operating lease or do you have a financing lease? And then just going through and making the adjustments on a monthly or annual basis, however you see it fit.